reposition assets for tax-free income. In this episode, I'm going to address the question, what should I do 5 years before retirement? Oh, I'm so glad you're asking that question, or you searched this out on this YouTube channel, because I've helped many people 5 years before retiring dramatically increase the liquidity, safety, and rate of return on their retirement assets and convert to tax-free income for the rest of their life. Are you ready to learn how you can do this? So my name's Doug Andrew. I've been a financial strategist, a retirement planning specialist, helping people actually optimize their assets and minimize taxes now for more than 4.5 decades. I've been so blessed and honored to have several best-selling books. One in 2007 became a New York Times and Wall Street Journal #1 bestseller. It was called Last Chance Millionaire. But as you stay with me in this episode, if you like to read and study and learn, take ownership of your future, I have a special gift for you. My most recent best-selling book, I'll gift you for free at the end of this episode. Now, I want to share with you that at retirement planning is something totally different than what you maybe did for retirement planning. So I'm going to simplify this. Most people who are going to be retiring in the next 5 years or so, when I sit down with them, I analyze where they have their money. And it generally falls into one or two or three or all four buckets. So watch as I explain these four buckets or repositories where most people have money that they are going to draw from during their retirement years. So we call these the four retirement accumulation and income buckets. Now, most people, when they would come to me, and the ideal time is at least 5 years out from retirement, they would be way too top heavy in this bucket. This is what I call the investment bucket. This is yet to be taxed IRAs, 401ks, usually invested in the market. And sometimes when people come to me and they're already retired or they're about to retire in a few days and they have most of their money here, I'm going, what are you thinking? See, I would recommend that no more than 30% of your retirement income come from this bucket. But most people are like 80, 90% or more. That's way too top heavy because money in the market, Wall Street was never built to create predictable income. If the market goes down, retirees are stuck and they can outlive their money. And so you don't want to have all the eggs in that bucket, so to speak, when you retire. Now, what are the other three buckets of the four? Well, some people have real estate, and that's fine. Some people only own their house. Others have rental properties, and sometimes they make mistakes of thinking their entire retirement is dependent upon rental income and these paid off properties, and then they get stuck when there's vacancies, when real estate markets plummet. And that's what they do every 7-8 years, just like the stock market. So I would recommend that no more than 30% of your retirement income come from real estate if you own rental income real estate. So that means you've got to start analyzing which properties you're going to liquidate, you're going to get your money out of. And you don't have to be a landlord anymore when you do this. You don't have to fix toilets, evict tenants, and take out the trash anymore. Life becomes very simple. So that is one of the buckets. We look at the guaranteed bucket. This is where people say, well, I'm going to get this much money guaranteed in their minds in Social Security. Well, the federal government is in debt. They owe $130 trillion in future Social Security and Medicare benefits to the people they've withheld from their paychecks. And they only have about 9 months of cushion. Did you know that? If they stopped withholding from people's paychecks that are workers right now, in 9 months they'd be broke. And so that system's a little bit scary. But, people say, well, it's the government. They can raise taxes. They can print money. Well, yeah, then that's going to cause inflation. But it also could be pensions, like a school teacher's pension or firefighters or what have you. There are also annuities where sometimes people want a guarantee. Now, I've never owned an annuity. I doubt I ever will. But if you want guarantees, you could put money into an annuity and maybe between 0 up to 80% of your income, based upon your risk tolerance, might be out of this bucket. Now, an annuity, there's only a handful of annuities I would even choose. They would be indexed annuities. But the magic is, if that annuity runs out of money at age 85 or 90, the insurance company must keep paying you an income as long as you live, even if you live to be 120. So if you want guaranteed income, you're going to give up on rate of return a little bit, but you might choose an annuity. I would recommend, not very much come out of this, but if you're really not a risky person, maybe up to 80%. My favorite bucket is this one, the tax-free bucket. Now, you might have municipal bonds in that. I don't invest in municipal bonds because municipalities are not being run very well. There's a lot of them that are filing bankruptcy all the time. So municipal bonds aren't as attractive or as safe as they used to be. You might have Roths. Now, Roths are a step in the right direction, but when you watch different episodes on this channel, you're going to hear me say that I've never owned an IRA or 401k, and I never will. I've never owned a Roth IRA or 401k. I never will. It's a step in the right direction, but Roths still have too many strings attached. There's only two benefits to Roths. You fund them with after-tax money, because if you believe that future taxes will likely be higher, a Roth will actually generate about 33% more net spendable income than the same rate of return, the same amount of money in a traditional IRA or 401k. Did you know that? But why would I own a Roth? It has two benefits. You accumulate your money tax-free. You can take out tax-free income. I have those two benefits in my favorite vehicle, which I call the Laser Fund. It is the topic of my most recent best-selling book that I want to gift you. The Laser Fund has always allowed me for over a century in the Internal Revenue Code to accumulate my money tax-free under Section 72E of the code. I can access my money tax-free under Section 7702. When I ultimately die, it does something that Roths will never do. It blossoms. It increases in value and transfers totally income tax-free to my spouse, my kids, my grandkids. Let me explain that a little bit deeper. I'm 68 right now. If I died in an accident tomorrow, every million that I would have in my laser funds would blossom to about 2.5 million within 3 weeks after I die and transfer to my wife, my kids, my grandkids, a church, a charity, whoever I want to leave it to. People say, whoa, Roths don't do that. No. Well, how much does that cost? Well, nothing's free, but it doesn't cost me anything. It's being paid for with a minuscule portion of interest that would otherwise go out the window in taxes if I had my money there, or even there. See, I like to transfer money over to the tax-free bucket. I would recommend you strongly consider having 40 to 60% of your money in that bucket at retirement. This is a strategic rollout. I explain this in other episodes. Please search them. This isn't a rollover. You're not taking money out of 401ks and rolling it over to IRAs. You're taking money out of this bucket, getting the taxes over and done with strategically over a 3, 4, or 5 year period, and taking the after-tax money. You take out money out of these not because you need to live on it. You're taking it out, taking care of the tax at today's lower rates, putting the after-tax money down here, where it's growing tax-free at a higher rate of return the rest of your life. And when you ultimately die, it reimburses you many times what you paid in tax. It's not costing you anything at the end of the day to do this. What does it mean? Are you ready? On this channel, I have a lot of episodes that talk about a strategic rollout, not a rollover. Again, we're trying to get the money out of those yet to be taxed IRAs and 401ks in today's lower tax rates. Get the taxes over and done with, but number 2, you want to reposition that money into something that's going to be tax-free from now on, earning probably double the rate of return that most IRAs and 401ks earn in the investment bucket. And we're going to earn higher rates of return. It's going to be more liquid and it's going to be safer, but it's going to be totally tax-free. Do you know that most IRAs and 401ks in the market only average about 3.5%? This is why the financial services industry came out with the 4% rule. They only want you to pull out 4%. My heavens, $1 million nest egg in IRAs and 401ks, they only want you to take out 40 grand a year, but you have to pay tax on that? Let's say in a 25% bracket, you're only netting 30,000. Those asset managers charge 1% on that million in asset management fees. If you subtract taxes and the fees, you're only netting 2%. In the tax-free bucket, the laser fund, I've earned 8%, very predictably for 45 years. Some years less than that, some years much greater than that. How much better is 8% tax-free than 4% taxable, which is only really a net of 2 or 3% after deducting taxes and fees? Folks, that's $80,000 a year of income versus $40,000, or really only $30,000 or $20,000 after taxes and fees. This is how we've helped many, many people dramatically increase their net spendable income by double, triple, and even quadruple. Another way to put it is, I've helped many people who their portfolios that I've talked about here, maybe we're going to generate $200,000 a year of income. They did really well. They were savers, but it was all showing up on the front page of their 1040 tax return. In 5 years at retirement planning, we got $120,000 of that income coming out of the tax-free bucket. Now, they still have $200,000 of income, but they only pay tax on $80,000. The IRS knows they're getting the other $120,000, but it's tax-free. It's been a sacred cow for over a century. If you take 33% tax on $120,000 that I got off their tax return, and the husband or the wife lives 25 years, I just saved them $1 million of unnecessary tax just with that one strategy. And that's only one of the strategies that I want you to understand. So empower yourself. Here's how you can learn more. So I mentioned my most recent best-selling book. It's called The Laser Fund. It's book number 11. It's flying out of our warehouse weekly. Hundreds of books go out almost daily. Now, I want you to claim your free copy. If you go to laserfund, Laser fund.com, and you contribute a nominal amount towards the shipping and handling, I'll cover the rest. You can also get expedited shipping if you want. If you like to listen and learn or watch and learn, there's other options in there. This is 300 pages of charts, graphs, and explanations. It also, when you flip the book over, contains 12 chapters with 62 actual client stories. When you read and study this, you will begin to become empowered on how you can move and reposition assets into the tax-free bucket. You'll see one example in here of how we took a couple from the highest tax bracket, they lived in California, to a 0% tax bracket in 5 years. They now have $8 million in their laser funds. They've been earning $600,000 to $800,000 a year of tax-free interest on their laser funds. They don't even need that much. $300,000 is all they can spend. Folks, this is a game changer. Consider repositioning some, maybe all, of the money that you have trapped in IRAs or 401ks over to a superior vehicle. Claim your free copy, study it, and we're here for you. Subscribe to this channel, share this video with others, give them the epiphanies and insights, and we'd be tickled to be able to educate you more on these powerful strategies.